have done business or met Bennett McDowell and his lovely wife Jean, they are at traderscoach.com, and they're going to round us out tonight. Let me get to his topic, creating a roadmap using Elliott Wave. Elliott Wave, very, very, very popular trading analysis. I think a lot of people are confused by it and looking for a simplified way to employ it in their trading. And I know that Bennett is a great teacher, so I have no issue with knowing that he's going to come over here and teach you something magnificent in the next 45 minutes to an hour. So y'all stick with us. And Bennett, I'm going to go ahead and make you the presenter so that you can turn your mic on and turn on your PowerPoint.
How are you? Can you hear me?
Hey, I can hear you, and I just gave you presenter status, so you should be able to slap your PowerPoint up there.
Great. Okay, give me 1 second. Get organized here. All right, can you see me now?
Yes, I can see you now. Excellent. I was going to try to make something funny about can you hear me now, but then I was like, oh, there's no way to be funny, Jeanette.
Well, that's always a good sign when you can hear me and see me, so that's a good thing.
All right, Bennett, thanks for coming.
Great to be here. Anyway. All right, you ready? Should I go ahead?
Yes, you may go ahead. The floor is yours.
Excellent. Thank you. Well, thank you, Jeanette, for having me. It's great to be here. You know, you had a great lineup of speakers today, so I was very honored to be part of that lineup. And last but not least, as it is turning about 8 o'clock there on the East Coast, so I know it's getting a little late, but we're going to make it worth your while because the Elliott Wave is something I think that everybody can benefit from. The problem I think most traders have encountered with Elliott Wave is that it tends to be a little subjective if you look at it only from a price standpoint, which is called classical Elliott Wave theory. What we're going to do tonight is give you an overview in combining the classical approach along with what we call the modern approach and talk about a probability matrix where you can actually get a probability on the wave count in which you've actually organized on your chart. So we're going to talk about that. Let me just ask a quick question here. How many of you out there, okay, have actually used the Elliott Wave or using the Elliott Wave? Okay. Good. Excellent. Quite a few. Like to see that. Okay, excellent. How many of you would like to learn more about it? How many of you have heard about it? Excellent. Okay, good. All right, good. So we've got a good spread of people that are using it. Some people want to learn more about it, so that's a good thing. So let's go ahead and get into some of the material here, and I think you'll find it quite interesting. Before we get going, just a quick disclaimer. You know, there's risk in trading. We always have to say this on our webinars, but I always say without that risk, there's no opportunity. And how true, not only in trading, but life as well. So also, too, we want you to come by, visit our website at traderscoach.com. Jeanette already introduced me, my Bennett McDowell. We've been in business for over 20 years now. I've been trading for almost 30 at this point, and I created the ART trading system and a variety of different software to deal with risk control and so forth. And I invite you also to check out some of our books and the reviews of our books on Amazon.com. We've written a book on just about every major topic in trading, a money management system. This is all about risk control. Doesn't matter what market you're trading, what time frame you're trading. There's concepts in this book that's going to really hone your risk control approach to the markets. The Art of Trading stands for the Applied Reality Trading. That's what ART is. That's our trading system that gives us entries and exits and trailing stops and so forth. Survival Guide for Traders is all about how to run your trading from your home like a professional hedge fund. We have a great business plan in that book as well, customized for traders. And then my latest book, which just came out, published by McGraw-Hill, is of course on the Elliott Wave, and that's what we're going to talk about today as well. So definitely we're going to cover some of the major topics in this book today. So very interesting stuff. Now, why would you use Elliott Wave, okay? What's the purpose of it? If you already have a system that gives you entries and exits, you know, why do you need the Elliott Wave? Well, the Elliott Wave is going to give you information as to what the market cycle is doing on the chart you're looking at. In other words, is it in a middle of a trend? Is it at the end of a trend? Is it in a correction in the trend? Or is the trend over? Okay, so it's going to tell you that, and we're going to teach you also how to arrive at probable forecasting areas using fib extensions and fib retracements for certain corrections. So we're going to cover that. It encompasses mass psychology in the form of technical analysis. In other words, the Elliott wave is kind of a unique structure, since it was actually developed by Ralph Nelson Elliott a long time ago in the 1930s. And it was something where he really was an observer of the markets. And he really didn't know why the markets moved in certain patterns. And even to this day, there's a lot of speculation. But the idea is that what he observed is that trends move usually in 5 waves. Waves 1, 3, and 5 are what he would call or label as impulsive waves. In other words, those are waves moving in the direction of the trend. Waves 2 and 4 are corrective waves, not change in trends, but corrective waves in the dominant trend. So there are 5 waves in a trend. And he noticed this not only on stocks, but a lot of different markets at the time. And it was kind of interesting because I always equate this kind of observation as one where you have, for example, astronomers look at a black hole, they see stuff going in it, but they really don't understand how it works, but they observe when matter gets close, it gets sucked in. And that's kind of what Elliott was observing. Okay, he didn't really know why it worked, but he observed that the markets had these trends made up of 5 waves. And later he analyzed that it was probably due to mass psychology in the markets more than anything else. All right, so the other thing, as I mentioned, we're going to establish price target zones. And that's an important aspect of the Elliott wave, because a lot of times, depending on your trading system or approach, you may know where to get in a market. It may have you a certain price level where you're going to get out, but you might not really have that good of way of establishing price target zones. So that's very important for your risk to reward calculation. So we're going to talk about that as well. So I really look at Elliott wave as kind of an overall roadmap of the markets. You still need an approach to get you in at the right time and out at the right time, but the Elliott wave gives you the idea of what direction you should be going in at all times, and that's important. So let's go move on and talk a little bit more. All right, so as we said, the Elliott wave is a form of technical analysis, and again, investors and active traders use it to forecast trends in the financial markets. And also, too, the wave principle states that the collective investor or crowd psychology moves from these levels of optimism to pessimism and back again. So obviously, if you're in an uptrend, that's an example of optimism in the markets. When that reverses, it's going into pessimism, and so that's why markets can change so quickly. Okay, but these swings create patterns, all right, and these patterns are evidenced in the actual price movement of a market at every degree of the trend. So the Elliott model says that market prices alternate between 5 waves and 3 waves at all degrees of a trend. All right, now this is an example of Apple stock, all right, back when it was reaching a top a year or so ago in September. And what I want to show on this chart is the 5 waves, and you can certainly see those, but let's take a look at those. All right, the first major wave up, all right, is wave 1, and I'm going to circle that right here. Then we had a corrective wave, this is 2, down here, surges forward 3, then we have another corrective wave 4, and then we topped out here in 5. Now this is an actual chart of Apple. And what's interesting about this chart is notice that there are also waves inside of waves. So this movement here up to wave 1 consists of actually 5 waves, minute waves, inside the major wave. And you can see those I'm circling here. And so one of the principles with Elliott wave is what they call fractal symmetry, in that no matter what time frame you're looking at, you can always go to a time frame either lower or higher, and the current time frame you're in will be represented in the wave count, okay, either lower or higher. And in this case here, all right, you can see that every impulsive wave, which are the 1s, 3s, and 5s, let me just mark those here, are all made up of 5 waves. So that's here, and then again here, and they all surge in the direction of the trend. And as you can see, there's 5 minute waves inside all the impulsive waves. And you can see it on one already. All right, now the corrective waves, they are usually made up of an ABC correction. And you can see that during these areas here. Wave 4 sometimes, and even wave 2, we have a complex correction, but we didn't have that in this case here. All right, so the important thing to take from this is that there are 5 waves in a trend, there are subwaves within waves, and then there are major corrective waves, 2 and 4, as well, that make up part of the trend. Now, classical Elliott wave theory and modern Elliott wave theory, it's really important to look at this as a combination of what Elliott worked on when he started out mapping the Elliott wave in terms of price movement, whereas modern Elliott wave theory is where we bring in tools like momentum, we measure volume, all right, we have all these sophisticated tools at our hands in the form of indicators that help us to confirm the price patterns we see on the chart. So we're going to show you exactly what that means and how these patterns repeat in behavior from the cycles of optimism and pessimism in the market. Let's take a look at classic Elliott wave first. All right, so here's what I was talking about in terms of the fact that we had, looks like we went blank there. Hold on one second. Let's go back. Okay, here we are. Okay, so here is what we have in terms of the 5 waves inside this one wave, all right, and that is a wave 1. Then we have an ABC correction that makes up a wave 2. Now, this is on a monthly chart, okay? Then in this example, if we take a look at the yearly chart to the right, notice this 1 here, all right, we transfer that over, is part of a larger pattern, okay? So again, that was just the beginning of a major move up, so there were 5 waves in that, followed by a correction, and then we went from a 2 to a 3 to a 4 to a 5, all right? Then we go to the 5-year chart, and so waves with inside waves, notice that this 1 here corresponds to this 1 down here at this point. So there are always waves with inside of waves, and that's the purpose of this slide, is to show you that this is kind of something that in order to verify counts, we like to see if it makes sense on different time frames. And if it doesn't, then chances are you are in some form of complex correction, and you should avoid the market or trading the market based on the Elliott wave at that time. So we like to look for clarity. That's one of the important things. Now here's an example, again, of how markets can be a little different looking, but still exhibit these patterns inside the major waves. All right, not all markets are nice and neat. Sometimes they look a little bit zigzaggy, like this one, but these are patterns that are actually representing the Elliott wave. Okay, and again here, one of the main emphasis of this particular slide, again, is to show you that even in the corrective waves, remember we talked about an ABC during corrective waves 2 and 4, guess what? The A wave in these corrections, yes, have 1, 2, 3, 4, 5, and then an A, B, C, and then 1, 2, 3, 4, 5 again in C wave. So both A and C wave have 5 waves in the pattern, whereas B wave only has an ABC pattern. So again, waves with inside a wave. Okay, and that's just another example of that same zigzagging simple ABC pattern. Now, we also have different types of corrections, okay? Some are called more complex corrections. And so these can occur during waves 2 or 4. And instead of a simple ABC correction, sometimes you may see a channel, sometimes you may see a zigzag, and notice here as well, this would be a classical pennant. And notice when prices break below the pennant, all right, that is usually the direction in which they particularly trend. So you will see that as a bearish result, and then here as a bullish result. So normally, when you draw a pennant, okay, or are able to draw a pennant, it's usually during a corrective phase in the Elliott wave. And it's usually the result of a triangular complex correction. So why is this important? It's important because it's important to realize that a lot of these things that we see forming, in other words, pennants and flags, all right, are always usually in corrections in the Elliott waves, either 2 or 4. So it's important when you notice that you realize that you're in a corrective pattern at that point. Here's an example of a flat complex correction. You still have an ABC, all right, but it breaks out either to the downside on a channel, like I told you before that sometimes you get channels, or to the upside. Here's another type called an irregular complex correction. All right, this is where actually B wave, okay, is quite extended, and then sometimes you get C wave. All right, so it just shows you that there's different types of corrections. Now, a lot of people will say, you know, we get a lot of people saying that the Elliott wave is subjective, okay? Chances are the reason it is because they haven't yet learned how to combine classical with the modern approach. You have to realize that when you talk about an Elliott wave theory or forecast, it's what I call an ungrounded assessment, which means that it is a fantasy. It is a theory of what we think is going to happen. But if you're really good at Elliott wave, what you do is establish price targets that the price has to reach and do in order to substantiate or confirm the Elliott wave count. And when that does not happen, then you have an alternate Elliott wave account appearing. So price has to confirm, okay, what we think is going to happen in the wave count that has the highest probability. And if it doesn't, then there's always an alternate wave count of lower probability, but sometimes, you know, that's exactly what happens. So the idea is we want to take that subjectivity out of the Elliott wave counting. All right, so that's one of the goals that you want to be able to do. All right, and one of the ways in which we do this, okay, is we do what we call connecting the dots. And one of the things here we do, let me grab my pointer real quick, is the first thing we take a look at is we take a look at the classical approach, all right? And that's basically looking at price. Now we know that during a trend, for example, Elliott wave 3, the third wave of those 5 waves, is always going to be the steepest and fastest moving wave. That's the wave you're going to make the most amount of money on, all right? So that's the kind of things we look for. We look for certain price patterns occurring and so forth. Fibonacci levels are used for price retracements for the corrections, both wave 2 and wave 4, and also used for price target ranges for wave 5, which represent the end of the trend. Okay, fractals, okay? These are turning points in the market that usually indicate, okay, the end of a certain wave or the beginning of a certain wave. We look at volume, okay? Volume is a very important aspect of Elliott wave simply because volume is always highest on the middle of the trend, wave 3, and that's because most of the market participants at that time realize that that particular market is trending, and therefore the volume goes up as more people take advantage or want to jump into that market. Volume on wave 5, after we have that corrective wave 4, is always less than the volume on wave 3. So if you're looking at a trend and you're looking at volume and you see it less than what it was previously, then you know right away that that's an indication that you're probably in a wave 5. All right? Price compression, like we mentioned before, channels and pivots. If you see that, you know you're in a corrective area in the market. All right? And then we have something called a probability matrix that I put together. And we're going to talk a little bit more about this later, that assigns percentages to Elliott wave forecasts. All right? And this is based off looking at a variety of different confirmation tools, and we'll show you what those are soon. All right? And of course, we talked about grounded versus ungrounded assessments. You always have to use risk control. I don't care what type of trading you do, you have to have risk control, because sometimes even the most probable scenarios, okay, are only that, most probable, meaning they're not 100%. So you need to protect yourself against those times when the wave count doesn't do what you expect it to do. And that happens, okay? We're not perfect at all this all the time. But I can tell you, after doing this for over 20 years, that it is amazing how much more accurate and probable it is when we use it than when we don't use it. So it's a great tool. All right, let's go on and move on here. All right, now, the million-dollar question, of course, that everybody wants to know is, does the Elliott wave work? All right, and one of the things, the 6 areas that I focus on when forming my probability matrix, all right, is I look for clear price structure, all right, and stay within the Elliott wave rules. There's specific rules on corrections, pullbacks in the markets, on wave 3s, on impulsive waves, of how far they should go, how much they come back in terms of a corrective area. And we use Fibonacci and so forth on that. We also have an indicator I'm going to show you in a little while called the owl histogram, and we look for that. This is part of the modern approach of looking for confirmation and momentum on certain of the waves as they develop. And again, we look at volume. All right, we look at fib levels. We look at the PTF indicator confirmations. This is another indicator, part of the modern approach that we look at. And then you can also look at multiple time symmetry. And that means, back to the waves within side waves, does it make sense? Are you seeing, for example, on the weekly chart, a wave count that makes sense on the daily chart as well? So if you're in a impulsive wave on the daily chart, you know, what does that represent on the weekly chart? Does it make sense? Likewise, you can go down to the intraday time frames as well. All right, so these are the 6 areas that we focus on to take the subjectivity out of the Elliott wave count. So let's move on here. All right, here again, all right, to show you, this is another example here of Apple when it was moving up and we had a wave 5 target zone. So let's just talk about this for a moment. All right, a couple things I want to point out here. What you're seeing for the first time is this indicator down here called the optimum wave locator, or OWL. Notice here, the OWL is a measure of momentum. And the idea here is what we do is we look for when the OWL peaks. And that was in this area here. The peaking OWL, and also in response to fastly rising prices, is a high probability confirmation of wave 3. All right? If this OWL here later on was higher than this one, then this would not be wave 3. Okay? But that was not the case. It was a wave 3. Now, this was looked at during the market as it was unfolding. All right? We're looking at it obviously in hindsight, but as this market's unfolding, this OWL here was huge compared to any previous OWL. And then look at the price movement, okay, as it goes straight up. These triangles you see on here, this is our trading system called ART. Okay, this is what gives us entries and exits. But right now, I just want to focus on the Elliott wave. So this was a 3. So we got close to the top, and look at the indicator. It went from above the 0 line to below it. That's our first indication or confirmation that we're in a wave 4. You have to have an oscillator below the 0 line during a bullish trend for a wave 4 to be confirmed. So the oscillator has to go negative, and also too, that makes sense. Look at some key levels of support that you actually exceeded on this move down during wave 4. Now, if you want to label wave 4 the ABC, here it is, A, B, C. So that would be an A here, B here, and C, and that ended right in the proper Fibonacci area, which is, I left the Fibonacci retracements on for this right here. Okay, that's between these two lines, which represent 38.2 and 61.8. 70% of all wave 4s end in this range here. Okay, 15% go to this range, and then 15% are a little shy of that, up to the 23.8 fib retracement. So then after this level was reached, notice momentum on the owl went positive again. Okay, and then we started taking out support levels on the corrective side, and that was your wave 5. And then our wave 5 target zone is a fib extension, and it starts at 61.8. And prices hit that, and then the owl went negative again, and you never saw it go positive again until prices were pretty low. So that was an indication both from a standpoint of the fib extension level being hit. You had a owl histogram level here that was lower than 3, so you had bearish momentum. All right, and this indicator here had no more green left in it. In fact, it started turning red. So that was all signals indicating at that particular point that wave 5, okay, had been reached and terminated at the wave 5 target zone. So it's a combination of using some of the modern approach along with the classical approach that will increase your odds in making much more accurate forecasts than just using price alone. Let's take a look at another here. All right, here's a short trade, okay, down into the target zone. And on this case here, all right, we've labeled this a 2. All right, this would have been a 1 here. All right, we moved down here on a 3. Okay, 4. And on this case here, all right, into the target zone. And you still have a negative momentum there because those blue lines representing the momentum are below the 0 line. You also have a red PTF indicating that there are more lows to come as well. So you're not quite at the bottom yet. And you certainly wouldn't want to go long here at this point with those kind of readings. But we do know as we reach the wave 5 target zone that eventually the momentum should change and we should start to see movement back to the upside. But for right now, these signals are all still keeping us to the short side. So in this case here, again, modern approach is adding these indicators here to help us isolate more precisely when a particular trend has exhausted. And if you notice the count here, we have a 3 here. Okay, we had a bullish 4 here during the upswing for a wave 4 correction. And then we had a wave 5, and the wave 5 owl was less than the wave 3. Okay, if by chance this wave 5 continues down so sharply that the wave 5 owl exceeds wave 3, well then we change the wave count, and this would be a wave 3 target zone down here instead of a wave 5, which means even more lows are coming, but not the case in this case. All right, so let's take a look at some more here to see, kind of get the hang of how we combine these things. This is a PEIX. I don't know if anybody trades these, okay? All right, so take a look at this. This is a situation here where you had a movement up. We've labeled the Elliott waves here, 1, 2, 3, 4, and 5, okay? And notice here that in this case here, the strongest move up was this right here, and notice that corresponded with the histogram at the highest level as well. So that confirms a good wave 3, all right? And notice we go into an ABC correction for wave 4, and we have to have a negative histogram here. We got that. And then finally a wave 5 again emerges, all right? But notice that the owl is much lower here than it was during wave 3, but we could still calculate our target zone, of course, all right? And notice prices are just knocking at the door right there at 61.8 to 100%. So this was the target zone back then for PEIX on this particular move up. So again, this was a nice clean example, all right, of both all the major impulsive waves combined with the corrective waves to equal 5 waves to the end of the trend. All right, let's see what we got here. Yeah, Tony was saying, you know, he's had trouble with the Elliott wave, okay, lost some money on that. A lot of times, Tony, the reason is that everything is probabilities, and if they only use price in terms of following the wave count, it gets a little bit tricky because sometimes, if you notice even on this chart, you have a fairly steep wave 5, all right? But look at this wave 3 and then look at the owl. So the owl's highest here, which indicates that this is not a 5, it's a 3. And then after this, we had the start of 5, and the owl was much shallower here. So that was an indication at that particular point, especially after the negative wave 4 owl, okay, that we were going to probably, in terms of probability, everything is probability, okay? We don't like to say anything for certain. We like to use the word probability in the markets. But in a case like this, that's a pretty good probability we're going into wave 5. So at that point, once wave 4 is in and the momentum changes, then we can draw in the fib extensions to arrive at a wave 5 target zone. All right, so again, if you didn't have the modern approach down here, all right, it would be tough to really isolate what kind of movement some of these waves are. Okay, so I think that would help you a lot. All right, let's see here. Okay, on MACD, some people was asking me about MACD divergence. We don't use that on this. We actually find another indicator that is actually very useful for this, and it makes up the owl. Okay, it seems to be a little bit more accurate. Okay. All right, so let's continue on here. All right, I want to go back many, many years ago, okay? This goes back to really roughly 2000 and the summer of 2002, okay? But the wave 3 top occurred around 2000. How many people were trading back then? Just out of curiosity. I don't want to date myself here, but in any case, I remember when the markets were peaking, in 2000. This is all in the 1990s here, and this was the 98 pullback, okay, back in this area here. Joe was, okay, good times back then. But what happened is, you see, what's interesting is the market had been in a bull market for a long time, okay, really, you know, for the last, back then it was probably all through 1980, and through the 1990s is when you really saw it excel. But the idea back then was that, you know, brokers had a very simple strategy. They'd call their clients, okay, and believe me, this was back before the time of where online brokers were really most popular. The only online broker back in the mid-1990s that really was reliable was probably Schwab at the time. They kind of did a breakthrough thing with online brokerage at that point. But most of the others were basically, you know, full-service brokers, and your, you know, account executive, whatever you want to call them, would call you and make recommendations. And during the 80s and 90s, every pullback was an opportunity for them to call their client to do what? Add to their position, okay, because it had always worked before until 2000. And what happened in 2000 is you had a wave 3 top, and then the market fell apart, all right, and started coming back down. So when a broker, for example, would call somebody during this period or this pullback to buy more, all right, it wasn't working so well, okay? But what we were in is, and the reason was because we were in a wave 4. So it would have been much better if, for example, they looked at they knew Elliott wave and knew that the high probability target zone for a wave 4 was right here. Okay, and I got to tell you, guess what? That's exactly what happened. Okay, in March of that year, the markets turned around. Okay, big time. It's March of 2003. All right, and they reached this target range around 7,500. And I can remember talking to some of my associates back then that we were due for a wave 4 correction and that it would pull back and probably go into the 7,000 price range. And they just couldn't believe it. All right, so this is exactly the kinds of things where the Elliott wave can be very counter-intuitive in terms of going against the herd. All right, so there's times when the market will, this is obviously a wave 3, look how steep that is, and then an ABC correction as marked that ended here, and then we went to new highs again after that. And of course, during this period here, one of the interesting things that happened, of course, was that during that correction, you had the dot-com bubble occur, but you also had, 9/11 occur too, which caused it to sink as well. Now, what's interesting is this level for wave 4 that we drew on here was a fib retracement. All right, it had nothing to do with basically anything in terms of what was going on in the world. Okay, it was a fib retracement based off the mass psychology produced by the run-up from the wave 2 bottom to the wave 3. So it's kind of interesting. This is one of these observational things that kind of just happen that create a high probability area. All right, so that was way back when. And let's move on and take a look at a couple more things. All right, let's take a look at some live charts here, okay? This will be kind of fun. And hopefully you can see this here. This is the natural gas fund. Now what we like about this is a live chart, okay, using the TradeStation platform. And what we like about this chart here is that we're thinking here on UNG, this is a pretty significant bottom, all right, wave 3 bottom here. We think a target range for this, for a wave 4, is in this area here. And that means that if it gets to that area, all right, we're talking about $13.75 up to possibly $18.79. And we're sitting at $6.55. How many people think that would be a good risk to reward? And where would you put your stop? First of all, what's the profit potential here? Almost 100%, right? Not bad for a corrective wave trade, okay? So when you have a risk of reward so in favor like this, this is one of the times you may want to take a counter trend trade. All right, and so the idea is you want to keep your stop low, right here, below wave 3, until you get up to the 23.6 fib retracement area, and then you can start moving your stop up because you should be in C wave at that point, okay? So that's very important. So based here, we still have negative momentum, okay? You might want to wait for that to turn positive, but nonetheless, you're getting a great entry, 6.55. Your stop would be at 5.63. And your potential is almost 100%. I'll take that trade any day, okay? This is a live market, okay? So this is one that you certainly might want to think about for yourself, all right? But also please note that, I don't know if a trade like this is suitable for everybody. I don't know your personal situation, so please check with your somebody in your financial network that approves trades like this for you to make sure it is suitable, okay? But in my opinion, I think this is a great trade. All right, let's go on. Let's see what else is out there. How about, let's see about this one. Let's take a look at WPRT, Westport Innovations. Similar situation, but here's where some of the modern tools are going to help us here. All right. notice we got a really, really big owl here. This is 3, right? This whole move down is 3. So we're getting close to the bottom of 3. Look at the bullish divergence. Bingo, all right? You still have a couple things here. One is you have a red owl, all right? So we don't want to go quite long yet, all right? What I would do here, depending on what trading system you use, is wait to see if you get a long signal on your trading system, and then possibly look to take it at that point. Now, the next question you got to ask, though, before you do that is what? What do you think you need to know before you can actually make a decision to think about a long trade here? What do you think's good to know? Where's the target range, right? What's the potential profit? All right, and for that, okay, we need our fib tool. So we go grab our retracement lines, look for a 2 here, draw it all the way down, all right, and here we're looking, let's zoom this in here, all right, let's see where prices are now and where that first target area is. So we're all the way down at $2 with a potential at 1092 as a first area, and that's where 15% of them reach, but most of them go to 16. Do you think that's a good trade, setting up? You betcha. Eric is saying, some people are saying that the S&P 500 has formed a wave 4 retracement. Let's just take a look at the Dow, all right? What's interesting here, you can see my analysis here on it. All right, this is my wave 4 target zone here. This is a 3 here. All right, so we could be in a 5. We have ended below 23.6, 15% of them in there. All right, 70% in here. We still have negative momentum. I'd be a little reluctant to jump on board yet until we clear this area here, which should drive the momentum positive, okay? But it's also I've seen this before, it's also possible it may sell down again, go into the wave 4 target zone, and then take off there. That's also a possibility, okay? All right, so let's just go back to that one chart here and take a look here. Give me 1 second to get it back. Thank you, Eric, for sharing that. So this is another potential trade. And so the idea here is that we want to look for a long trade when some of our indicators at the bottom turn bullish, okay? A little too soon to get in here now. I'd wait for them to turn bullish and then put your stop at the very low, okay, that you can on that market. All right, so that just gives you a couple of examples on this time frame that you can look at. I mean, you know, if you go to the Forex market, all right, you'll have some other things you can look at here. This is getting close to a bottom too. Notice a bullish divergence, all right, and so we're getting close to a bottom here. Here's a wave 4 correction. This is a 5, so we're at the bottom of a 5 here, okay, so that's significant, and that's on the Euro-Japanese. Okay, so a lot of ways in which you can use the Elliott wave on a variety of different markets and intraday. The same theory we use on the S&P E-mini as well, 2-minute time frame when we're day trading. All right, so I just wanted to I'm going to go back to the PowerPoint, but I just wanted to share some live markets because I think it's helpful to see some of this stuff and what's going on today. So just to kind of recap here, some of the things that you want to look at in terms of making sure that your Elliott wave count, okay, is as accurate as possible is don't take just the classical approach, all right? You learn to use Fibonacci. You learn to use the owl histogram indicator to help confirm Elliott wave counts. Take into account volume. Notice we've got to talk a little bit about the probability matrix as well, and you got to use risk control. So all these things really round out the proper way to trade the Elliott wave. Now, We got a special, of course, today, and this is on our Elliott Wave Home Study course, where we actually go into the probability matrix for you, okay? So everything you need is in this course. We also give you in this course how to draw fibs, all right? We draw them a little differently than other people. We have done a complete study on the best way or the most accurate fibs that work, and they're drawn from certain Elliott waves down to certain levels, so that's covered as well. And I guess there's going to be some type of link that somebody will put up in the chat area, and I think we already got it there now. It looks like good. So we got a link there. If you click on that, you can order the Elliott Wave course, and it's all online. Nothing's shipped to you, so it's very simple to use. You know, you have access to it 24/7, lifetime, and that's it. So. You know, any questions before we wrap it up here today? Okay, I think we got them all. Let me just make sure, because some questions came in. All right, I think that's it. I think we got them all, okay? Very good. The course is very comprehensive because it goes into great detail on, somebody's asking a question about the course. It goes into great detail and has homework assignments as well as video. So it's very, it's visual as well as intellectual, let's call it, okay? So there's a study manual and so forth, okay? All right, well, that's it. Jeanette, thank you so much, okay? It was great to be here. You have a great audience. I appreciate that. Appreciate all the response out there. So everybody have a great week, and listen, have a good Memorial Day too, okay? We'll see you back here hopefully next time, okay? Hopefully we'll do this again soon. I always enjoy doing these. All right, have a good one. Thank you, Jeanette.